The summer is flying by, and before you know it, we'll all be back to school. And this is back to school. So I hope you brought your school bags and your lunchbox. Welcome back to Leo, Dr. Carole, and Mike. Nice to see you guys. Let's kick off this morning with Dr. Carole Nakhle, CEO of Crystol Energy, now sitting in the luxury of a London apartment, I believe, back in the sweet spot. Carole, welcome back to the table. Oil prices this week having a bit of a tear, up 10% until this morning in Asia. Prices have opened a little bit down, but nonetheless, we've seen a lot of volatility over the period of August. Your thoughts on where things stand?
Good morning, Sean. Good morning, everyone. It's great to be back. And yes, I'm sitting in a London flat. But as you said, London, I mean, Sean, you feel that the summer season has passed by without much of the things we expected. And here in London, for example, when you look around, it's the first time I see London. I've been away for almost 2 years, but it's the first time I see London during August so quiet. I mean, it's amazing. It's even quieter than the Black Forest, so you can sleep very peacefully. And this is a reflection of the realities on the ground and what that was translating in terms of impact on oil markets. Because remember, a few months ago, everybody was expecting a strong pent-up demand. Everybody's traveling, going around on holidays. I know that the airports are busier than normal, but we have to understand what we are comparing them with. But actually, in terms of the holidays that we have been accustomed to, we are far from being at that level. So there's still a lot of uncertainty. If you look at demand forecasts, for example, and I'm going to refer here, for example, the IEA or OPEC monthly report, even though OPEC maintained its demand forecast stable, you can see the IEA since June actually has been revising its demand forecast downwards. And this is a bit different from what we expected. At the same time, we're getting still mixed signals on the economy. We thought everything was going fine, particularly in Asia. I mean, China was the first country in terms of putting money in to support the economy, but it was the first country out in March, for example, this year, as they started to withdraw their financial support to the economy. But this turned out maybe today too soon, because nobody really expected the virus, the Delta variant, to spread so rapidly across the world, and particularly in China. So, for example, if you look at data, economic data for the third quarter for this year, for Asia and for China in particular, they have been revised downwards. So on balance, we don't know where we're standing yet, because we expected a beautiful sunny holiday season, and this did not materialize. And we still have the uneven growth around the world. The spread of vaccination is still uneven, and this translates into the volatility that we are seeing. And unless things change more robustly, we have greater clarity. Even in the US, we have greater clarity about what the Federal Reserve is going to do, for example. We should expect to see this volatility continuing in the market.
Let's welcome Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, despite all of the volatility as such, particularly the last few weeks, down 8%, then up 10%, prices are still at $71 a barrel on Brent. That's pretty chunky.
That's the problem. It is chunky. And I think Carole nailed it with demand estimate revisions heading downwards. A lesson I learned really early in the business. It's not so much what the market's doing, what expectations are. It's the process of the estimate revisions. They're all negative for demand. And your number 6 headline, I think, really nailed it too. Signs of new shale discoveries in China. And to me, that's the bigger issue. And the bigger macro issue is the elasticity of supply in crude oil has been the major headwind for crude oil prices for at least a decade, and that's really kicking in. So everything's negative. I think the market's picked a pretty good high. We've had that bounce post-COVID recovery. Now we're realizing not only are we not just going back to normal, that might take years, but supply elasticity is still there and it's coming in. So here's my key thing I'm worried about. In the U.S., average cost of shale production is now $35 a barrel. The last time WTI reached that high that we reached recently, around 75, which is in 2018, the average cost was $50 a barrel. So I look at it as like that get her done, that get her done, get her supply mantra in Texas is it's just a problem for crude oil. So I think the market's peaked, like lumber has peaked. And I think it's just a matter of time we slog around in this range for a while, and we just need a higher stock market to stabilize at these levels. And you see it this morning, Hang Seng's down a little bit and crude oil's down. So we need the stock market to continue rallying. Otherwise, I'm worried every commodity is going to go back to the 5-year average, and crude oil is closer to $50 a barrel in WTI.
Let's welcome Leo Tameeris, CEO of NRG Global, sitting in Singapore. A lot of talk there in those early comments this morning, Leo, about the outlook for China and Asia, demand it's having this uncertain period. What does it look like from Singapore?
The demand in areas in countries other than China looks pretty bleak. There's still a very high level of daily infections, daily cases in many countries. Sydney had a daily record yesterday. Malaysia, Philippines, Indonesia, they're all at very high to record high levels. So the demand in Southeast Asia, Northeast Asia, I think will recover much slower. China, I'm not that pessimistic on anymore. They got the COVID, the Delta variant under control. We see them easing up the credit supply again into the manufacturing, the infrastructure, real estate sectors. They're importing record levels of iron ore again after the price dropped 45% from the highs. So China looks more optimistic, I think, than they put this policy in place to favor longer-term growth over longer-term stability over shorter-term growth. But they're pushing ahead. They're pushing ahead, and the openness easing up again, slowly opening up again domestically, not internationally yet. So I think that there's some optimism on the China side.
Leo, is there a shift in the Asian outlook regarding vaccinations, that vaccines is the strategy, is the gateway to the new economic and social security, or is that still not a narrative in Asia?
No, it is. I think the countries are realizing that you need a vaccination in order to get things under control and go to any kind of semblance of normal again. And they're stepping up the vaccination rates. You see Australia stepping up, Indonesia, Philippines, they are scrambling to get enough vaccines and vaccinations organized. Singapore is 80% plus at the moment. I mean, the only 3 countries in Asia with very high levels of vaccination is still China, Hong Kong, and Singapore. But the other countries are stepping up, are coming up, because they realize that that's the only way out in the longer term.
Carole, I'm wondering, and it's probably a conversation for another podcast than ours, but I'm wondering if London's quietness is Brexit got anything to do with it? The whole that's buried beneath this COVID nightmare. People just thinking, it's too much of a hassle going to a non-EU country. I don't know. It just seems something to think about. But OPEC plus sitting on the back of this volatility, Carole. I'm wondering, from your perspective, does it shift their thinking in any way, or do they stick with the current strategy, locked in 400,000 barrels per day each month?
I mean, you touched on an important point that the prices where they are today. I mean, look, again, we go back to the issue of expectations, because a few months ago, everybody was really looking at focusing on $80 plus oil price around this time of the year. This did not happen. So we tend to look at the volatility and the decline in prices, for example, from their high that we saw last month to where they are today, as something very negative and that the market is collapsing. But that is the false image, again, because we are comparing it to a certain threshold. However, where prices are today, I mean, Brent around 70 plus or minus a couple of dollars here and there is actually quite healthy, especially if you compare it to where the prices were exactly a year ago. That is already a major achievement. And I'm not quite sure whether the 400,000 barrels a day that OPEC was planning to put in the market, between now and December is going to really break the market unless something else changes significantly. So I'm not quite sure. I still haven't made up my mind yet about what they ought to do, or what they should do when they meet next week on the 1st of September, if I'm not mistaken. But I don't think there's a lot of alarming things happening in the market to make them postpone their decision. And at the end, don't forget that President Biden was asking them to put more oil in the market. So maybe they're going to please him and keep it that way. But on a more serious note, really, I don't think that the oil market is collapsing. We have to be very, very careful with the media's reflection on certain terms like rally or collapse or whatever, because where they are today is actually comparable not only to only a few months ago, but they are much better than last year. But if you look at healthier periods, let's say in 2018, they are easily comparable to those levels. So we should be careful with the way we translate the current price environment in terms of the healthiness of the market.
And Mike, of course, we have the Jackson Hole meeting starting today. We get a sense from Carole what OPEC thinking might be. If you were sitting in Jerome Powell's shoes, what would you be frantically editing your speech? Would you be changing? What do you think the tone is going to be set by Jackson Hole?
Well, I think they've been quite good about alleviating the volatility around taper. And that's been the key focus, because that was the key issue back, I think it was 2013 when they started tapering and we had that volatility. So the market's been, all the Fed representatives are doing everything they can to make sure the market's well prepared for taper. And that's one of their key things they always want to do is minimize volatility as much as possible. But the issue with taper is it's still a dream. I mean, I look at it as they have to prepare the market for it, but they have to start it. And once the stock market starts mean reverting just a little, most commodities are going to drop with double the velocity. That's the problem. That's just where we stand right now. And I really appreciate what Carole said about President Biden and OPEC. We're getting closer, almost a year away to the midterm elections. It's getting political. Obviously, it's always political. And finally, Biden realized, yeah, it's just great. There's all this new energy focus and everything. But the best way to get elected is not having crude oil prices and gasoline prices too high. It's getting them lower in this country. So there's going to be that pressure politically. I really appreciate Carole pointing that out. So that's why I think the cap is in commodities. And it's just a question how much we mean revert. So I don't see the upside. I guess sometimes there's upside when we're too negative. But that's the problem. I see the main correlation for all commodities, most notably crude oil and copper, is this unrelenting stock market that's no longer, it's there. All commodities are showing divergent weakness to their latest highs in the stock market, which to me says it's a lose-lose for most commodities.
Mike, just to pick up on that Biden comment, we touched on it earlier in the week, I'd welcome your thoughts. Is Biden damaged at all by Afghanistan domestically? Does it restrict or limit his ability to throw his weight around?
Well, yes, initially. I mean, we all know the ratings are down, but it's his only first year. If this is his fourth year, it'd be a big issue. Right now, I think he was astute enough to say, if we're going to do this, let's pull the plug, get it over with now. And I think that's what the thinking is. Also, I think there's significant amount of intelligence behind the scenes that are designed to make people think this is all a bad situation. But the intelligence behind the scenes is a little more, I think, more astute. We'll find that out in a few years. But no, they still have a Democrat majority in Congress, and we're getting the infrastructure through. And the key focus is keeping that majority in the midterms. But they all kind of agree on key things as far as bashing China is good for votes, bashing Iran is still good for votes, stuff that President Trump taught him.
Yes, left on the doorstep. Leo, we saw the inventory report out of the US EIA yesterday. Again, another 3 million barrel decline. We're still in a market in which inventories are falling. Despite all the noise, everything else, they're falling in China, they're falling in the US. That is going to be supportive to prices.
It should be, but
go ahead, Leo.
Sure. The floating in storage is increasing again.
Right.
It's not by far not at the levels of last year. Last year, around 250 million barrels floating around. That went down all the way to 125 earlier this year, and now back up to 150. So the people are putting more oil in floating storage again. So that is hampering. On the other hand, I mean, of the 250 million barrels that were floating last year, all of that could be imported into China. A large part of what is still afloat at the moment is what they call the bitumen mixture, and products on which China slammed a massive import duty to stop it from coming in. So that is still floating, but can't really be imported unless it's blended down, probably. So it's a floating storage is increasing at the moment, but not all is importable.
Well, part of that floating storage, Leo, is barrels from Iran and Venezuela, which is generally regarded, at least from America, to be under sanctions. And so China seems to be resisting or holding off as compared to previously when it was taking that in. Is that likely to shift? What's your thoughts on that?
I don't think it's because of the origin that they're holding off.
Okay.
I think they've been trying to do a little bit the same as what they successfully did with the iron ore. Force a decline in demand, decline in imports for a while in order to get the price levels down. In oil, in iron ore, they have much more power, much more muscle than in the oil market, of course, to do that. So it's I think they've been drawing down their stocks. They're drawing down strategic stocks, mainly to avoid paying the high prices as well, and to have some impact on lowering demand in the overall market. So I don't think it has to do with the origin, but it's more on the pricing, the price levels, etc., and the slowdown that happened, which I believe is going to pick back up again now.
Carole, you mentioned in your earlier statement the idea of the outlooks from the major sort of multilateral agencies are going to look at the downgrading in forecast. Do you expect that to continue? The IEA, others, we're going to have to reposition their demand recovery outlook for this year and into next year?
Demand revisions in oil markets are pretty common. And if you trace, for example, the monthly reports of these agencies, IEA, EIA, OPEC, they always have revisions. But what is striking is that if not only to compare the demand revisions in, for example, last year compared to today, because there isn't much we learn in terms of modifications, but it's interesting to look at the IEA and OPEC's forecast as of January, for example, this year. The gap there between the two agencies was more than 700,000 barrels a day in terms of forecast, with OPEC being very conservative and the IEA being extremely bullish in terms of the outlook for the year. But that gap has changed over the last few months. And as of May, the equation reversed because OPEC has become more bullish about oil demand outlook and the IEA became more conservative. Is there much to read between the lines? I mean, about this data, I'm not quite sure, but it will be interesting to see, because OPEC's forecast between, let's say, June, July, and earlier this month, they were pretty stable for oil demand, whereas the IEA became more pessimistic. So I wonder whether OPEC's, the data with OPEC is more politically driven to achieve a deal, or they are really convinced that the market is stable in terms of demand. And who knows, maybe they become more optimistic, but maybe they will become more pessimistic in their forecast. But overall, I mean, there is little we can learn from these monthly revisions. It's just a reflection of what's happening in the bigger scheme of things. But, we are still in a COVID-dominated world. Yes, some people, they want to get over this one and move on with their lives. But the reality on the ground is that the majority of people around the world are not vaccinated. And add on top of that, remember last year, we were talking about structural economic scarring that would emerge from the pandemic as we progress in time. And these have started to emerge, especially in emerging economies, for example, in poorer and low-income countries, because they withdraw, especially their fiscal support, perhaps earlier. They could not sustain it, for example, longer than what you have here in Europe, in the US. We are having greater inequalities emerging. You mentioned earlier the Jackson Hole Symposium. Their main theme is tackling inequality or uneven growth. So that is going to be becoming more and more of an issue, and that will weigh more on oil markets in the future, because the growth for oil demand is not coming here from Europe or from the US, not from the OECD, where demand peaked in 2005. It is coming from emerging and advancing economies such as Asia in particular. So we haven't heard the end of the story yet, and we should look beyond these monthly revisions because, as I said, they are not drastic, but they can reflect a little bit of, the overall thinking about where the markets are heading towards the end of the year.
On that point, Mike, obviously the Jackson Hole and the Fed outlook is a critical piece in sort of giving direction as to where it seems to me we're kind of entered this transition phase of trying to get onto a normality path where things become, they move out of this ultra easing accommodative policy to one that is slightly more restrictive. And in between, we're going to be in this volatility turbulence. I'm wondering your thoughts on that. Of when do we get clarity? When does the new path become sort of committed to, if you like, and it becomes clear, and so everybody can sort of reference off of that?
Yeah, exactly. When does it? But I think Carole and Leo both pointed out the revisions in demand and supply are all negative. And the key thing people need to remember about crude oil is a bear market before COVID. I was bearish on crude oil. Remember, it peaked near 80, and Brent, and demand and supply were both negative at the time. And now we're trying to come up with a more bullish scenario. And we've had a bounce. And what does a bounce do? It brings on elasticity of supply. That's been the bane of commodities forever, and most notably the last 10 years in crude oil. So to me, normality in crude oil is back to that situation, accelerated trends in decarbonization, electrification, and just rapidly advancing technology, bringing on more supply. So I don't see the upside for crude oil. I see it more in commodities that have lack of supply elasticity, which is more gold, silver, and Bitcoin. So I just have to be honest, as far as normality, it wasn't good for commodities before. So why is it going to be good for commodities after COVID, if we ever get through this? And I look at it as what I see, everything I see in this country is everything's going backwards. We're all putting masks back on. The cases of hospitals are off the charts. Children are going to the hospital. I mean, people aren't dying as much, but everything as far as demand for COVID and everybody's relocking back up. Every place I go now, you have to put a mask, or I'm more restricted than I was 4 months ago.
Are you saying that tapering isn't a done deal? I mean, it's next month. It's actually still a question mark.
Tapering needs one little thing to come right back, and that's a little stock market mean reversion and volatility. The S&P 500 has not corrected more than 10% since last year's low. Once it does that, crude oil is going to drop 20, 30, 40% in a heartbeat. It's been part of this deflationary trend commodities that's kept the Fed able and most central banks able to provide a lot of liquidity. It's just accelerating, and it's all dependent on the stock market for the Fed to taper. They can test it for a while, but once they, and it's all they're pointing out in interest rates. U.S. bond yields have started to decline. The Chinese have cut their reserve rate. It's never a good thing for commodities when trying to cut their RR rate. The trend is down in rates. I think they're picking up the lack of demand, picking up the trends that were before COVID, and the tapering is still a dream.
Okay, well, let's go to the survey question, which is sort of trying to look beyond what I thought was that the tapering window. 2022 will be beyond the tapering uncertainty. But this year marks the 7th year in a row when the average price of Brent has changed by a double-digit percentage. Indeed, only 4 years of the last 20 have we seen a single-digit change to the average annual price. We've seen a lot of volatility, and certainly the last year has been massive, right down to 20, up to 80. But every year over the last number of years, we've seen volatility. So my question is, for 2022, what scale of volatility will we see in 2022? Will we see another double-digit big change, or will we see a single digit, that leap year in which prices don't change that much? The average price this year to date is $67 on Brent. Last year, it was $25 lower. The year before that, it was back up in the high 60s. So the question is, volatility in 2022, will we see another year of double-digit change or single-digit change? One of those leap year moments when things change a little rather than a lot. Leo, big part of that might be where China goes. Obviously, China cut back on its buying over the last quarter or so. We've seen that in all the data numbers. They've drawn on their strategic reserve, 30 million barrels expected over the coming months to draw on their strategic reserves. But the question then is, will they go back to buying a lot because they'll want to refill all those? Your sense of where China buying goes in the last quarter?
I believe that, as I mentioned earlier, I believe that there are signs of improvement in China, and they're easing up. They're putting more credit, more money into the markets, especially to stimulate the smaller businesses.
What about the clampdown on the big billionaires and tech and different? I mean, a lot of government intervention in the economy at the moment.
I think the clampdown on tech and the big one has more to do with who controls the data than anything else. Traditionally, the Communist Party had a monopoly on information and data, and suddenly Alibaba and the others took over and had more information than the government themselves. So I think it's more to do with who controls the data than anything else. But no, I see things improving in China. One indication is the Baltic Dry Index. The Baltic Dry Index is back to 11-year highs earlier this week, and that's iron ore, coal, grains, for the smaller one, the Panamax sizes, and that's most of that is going into China. China in August imported a record high amount of iron ore after they saw the prices drop $70-80. Or made the prices drop $70-80 almost. So I see the same thing in the oil market. They have been putting restrictions on the teapot refineries, the private refineries, but I think those are coming back into more normal running rates as well. So I believe that we will see an increase in imports into China. Not by leaps and bounds, but a slow but certain increase in the coming 3 months.
Carole, as we come to the end of August, the end of the holiday season, the next sort of, amongst other big headlines coming up in Europe, is the German election. I mean, this is the biggest economy, the biggest, most important country in the European Union, going to face a change of leadership for the first time in 16 years in a month's time. How significant is that for Europe? What is the possible likely outcome, do you think?
You need Christoph to address that question.
I know, but by osmosis, you have harvested all of that wisdom.
I know, after 1 year and a half, being there.
After a year in Germany, you don't care, is that it?
And I don't speak a word of German, by the way, which is quite shameful.
But nonetheless, the outlook for the European Union has been rather positive in recent months, slowly but surely coming up on the inside lane. PMIs are strong.
Yeah, but Mike raised an interesting point about the Biden's administration, that when it's happening, at what part of his presidency. So the worst thing I think for a leader is when you have, or for a dominant party, is when there is a big crisis just before the elections, because the electorate, they have a very short-term memory, so they tend to punish that party for whatever things went wrong. And that's the fear in Germany. So many people are expecting, because of the way the pandemic was handled, because of the frustration with restrictions, that we could brace ourselves for more surprises. So that's all what I can say in terms of the way things are going in Germany. But to be fair, things have improved in Germany in terms of handling the virus, in terms of giving people more freedom for mobility and going around. So, but it's not the same as here in the UK, for example, where people talked about Freedom Day from July, and it happened actually. Hardly anyone wears masks here. Actually, I look like a freak when I go around everywhere with a mask, but this is a mentality I came with from Germany. So overall in Germany, it will be interesting to see, but the EU is doing pretty well. I think we saw first at the major economy, China, coming out of the crisis, the big crisis, followed by the US, and now the EU is catching up. And actually, you look at economic forecasts, whereas they were downgraded for the US and for China, I'm waiting for them to look for the EU to see if there will be any downward. So far, things are looking more robust in the EU than you find elsewhere. But what that means for the German elections, we should brace ourselves for some surprise, especially as you said, Sean, that they are coming at a time when you have a major change in leadership. So that's what I can say at this stage, but that is question for Christoph to talk about with greater passion than the Lebanese British one.
Yeah, I won't even ask you about Lebanon. We'll be here all day.
Please.
Yeah, that would be a 3-hour conversation, and then we'd only be getting into the foothills of it. Let's get the survey result and give Mike the last word this morning. Still a lot of volatility expected in this room for next year. Double-digit changes, single-digit 1/3. I think I'm in the single-digit camp at the moment. Mike, this weekend, we're at the end of our Middle East week here. Oil prices are falling a little bit after a big run-up. What is your expectation of the tone that's going to impact the markets the next 48 hours from Jackson Hole? Or have we seen all of the impact already because the tapering is more or less been taken off the table?
That's a tough one, Sean. I think in the macro, oil has peaked. The market's all set up for tapering. It's all going to be about the stock market as far as telling the Fed what to do. And bond market's already telling them that you're going to have to keep things liquid and keep providing liquidity to keep this economy afloat and keep volatility low.
Well, I thought it was an interesting statistic that we have had in the last. It was, I think, Christoph mentioned it again on last Sunday at the beginning of this week, that 60-something% of Americans didn't pay tax last year. That it's of a scale in terms of the amount of, and it's always sobering to look at that stat when you see the headline NASDAQ hits yet another record. It's a good reminder to see that 60% of Americans can't afford to pay tax or not in a bracket to pay tax, and hence why, as you say, maybe the central bank has to continue with its accommodative policies. Let's see what they have to say. Everybody glued to their screens over the Middle East weekend to hear from Jay Powell. What will it impact? We'll talk all about it on Sunday. Leo, thank you so much from Singapore. Mike, as always, from New York. Carole from London, sunny London, with you and Boris. Send them my regards. Hopefully you won't get the crowded streets of London back too soon and you can enjoy some peace and quiet. All the best. Have a great weekend, and we'll catch you on Sunday. Thanks so much.